Good afternoon. I would rather say probably maybe even good evening now. I'm glad that you are here. You know my name. I'm Krzysztof Jajuga. I'm from this university. It's my really privilege to be here with you to give some presentation about something that I consider is one of my main topics, which I got interest roughly 40 years ago or something like this. This is about risk in financial markets, and this is becoming also not becoming. It has become very hot topic in last years, at least last years. And I think I want to divide my presentation into three parts: past, present, and future, something like this. At least give the motivation for this one. So let's see. The title corresponds to the title of course, of the meeting. Will the show go on? Yes, the show will go on. But as I said in the very last slide, I will say it's not show business, right? First, I want to put, this is very much important because many people do this disclaimer. My disclaimer is this presentation does not reflect the opinions of artificial intelligence. So anything which is given here is possibly my opinion. So I'm taking whole responsibility for this. And yeah, that's what I should do here. I would like to start from the past. There will be two slides basically about the past, which gives motivation why I'm talking about this one. First slide you can see here. This is the historical slide which shows you, as you can see, the price or the value actually of the most important financial market index in the world, which is Standard & Poor's 500. You probably know about this. And this is the index of New York Stock Exchange, which is the most important probably exchange in the world of stocks. So you see here what happened. This blue line shows what happened. And until 80s of the last century, nothing happened because the line is pure flat. And then it jumped up. So the role of financial market became so important, I think like 40 years ago, something like this. And you see what happened. I may try to show it. Yes, you see this. There are jumps, of course, but basically it goes up. So this market is becoming so important. That's the first slide from 1789. The second one is, unfortunately, is the recent history in last, let's say, less than 40 years. This one is probably you have heard also about this index. It's called VIX, Volatility Index. It's published by not New York, but Chicago Board of Options Exchange. And this corresponds to how people feel risk in the financial markets, especially risk in New York Stock Exchange. This is called VIX. Some people say that it's a fair index. If it goes up, it means that people are becoming scared what's happening in the market. And you see here there are huge jumps. It started to be quoted from 1990, but you see these jumps, and these jumps corresponds to big financial crisis, for example. This one especially, this is the 2008, the big financial crisis because of collapse of Lehman Brothers, etc., etc. But then also recently, this was Euro crisis in Eurozone. And these are kind of recent things related to what happened in the last several years. And the last things, also these jumps corresponds to many, let's say, decisions of the administration of the United States in the last several months. So this is very important index, and people think that if this index goes down, probably the prices of stocks will go, if this index go up, I should have said, the prices of stocks will go down. So this is kind of signal, how could you invest? So this is basically past, but the past is also science. I'm academic for sure, but these are milestones in the science about finance. There are two names or three names basically, or even four names, but two milestones. The one is still very valid. It's Mr. Professor Harry Markowitz, who passed away last year, but he proposed to way how the people should construct portfolio of investments. So how can you make return and still keep risk at the acceptable level? So that's his theory. I mentioned this on the slide here. And the second one, which came 20 years later, this is about how to price, how to value instruments that are being used to hedge or to protect against financial risk, like the exchange rate risk, interest rate risk, stock price risk, commodity price risk. And they are mentioned here. So this is science. I still, when we teach, not only in studies, but for practitioners, they use this, of course, with the new methods developed within this area. This is the last thing about theory. because this is something that is called Nobel Memorial Prize in Economic Sciences. You might know probably that this is being awarded at the same time as 5 Nobel Prizes, but this one is not Nobel Prize per formal reasons. It's called Prize in Economic Sciences in memory of Alfred Nobel. What is important, these are the names of people who did something in finance. So this prize is being awarded since 1969, basically. And you see the names, including Harry Markowitz, for example, including these people who invented this pricing of these risk management tools like options. They are mentioned also as well. But what is also important, I should mention, there is one Nobel Prize laureate, which is used, unfortunately, he passed away. He was born in Wrocław. So we have Nobel Prize winner in Wrocław. His name is Reinhard Zelten. He was born in 1930 in Wrocław. And of course, in 1945, well, he left for Germany. He did a lot of studies in the area of game theory, but it's also part of economics, economic sciences. And he got the prize in 1994, the same year when the prize was given to his called colleague, John Nash. I believe you heard about John Nash, famous for the very famous movie Beautiful Mind, where John Nash was played by Russell Crowe, I believe, some time ago. Excellent movie, so I would strongly advise you just go to the internet and just get this and look at this if you didn't watch this yet. So these are these names, and you see some of them are also in these areas which are originally were not finance, but there are 2 names, for example, 2002 Daniel Kahneman, very nice book, which was translated to Polish. And the second one, Richard Thaler, 2017. These are people from behavioral area. So these are psychologists by origin, but they decided to do a lot of studies in economics and in finance. Okay, so this is it for the science. Now we go, I just want to mention one thing, that if you want to be successful in finance, you cannot be only financial person. Now, finance is very interdisciplinary, so the knowledge from different areas is useful, and I just mentioned several of them, but you can see, except for economics, except management, except for mathematics, which is very strong in finance, you see such areas like psychology, yes, mentioned, but also sociology. You know, now with the social media and these huge networks, there's a huge impact on what's happening in financial markets. So sociology knowledge would be also helpful. The next one, which I mentioned here, is neurophysiology. It means that what happens in how the brain is constructed may have an impact on what people are doing. And there are famous studies showing that if people lost part of the brain because of accident or something like this, they may behave differently than other people, but each part of the brain is responsible for some behavior. For example, perception of risk. Some people lost part of their brain in the accident, but they don't have perception of risk. So this is very important. Also, brain has some kind of impact of what's happening. And of course, there is cultural studies. The world is different. I'm not talking only about Islamic finance, but I'm talking about different areas, even within Christian religion. Latin America is different. Even in Europe, I mean, there's substantial difference between Scandinavia and between southern of Europe, something like this. So those people who work in the global market, they have to be aware of about cultural differences. Okay. Now, today, I just want to go to today. What drives financial markets today? I put some important things, in my opinion. This is, again, my opinion. Maybe 2 of them I would like to mention in next 2 slides, which are new types of risk and new types of assets. 40 years ago, this was not the topic because this was not available even or something like this. This is not important. So let's look, for example, about assets. So people can invest on these assets. Again, 40 years ago, 30 years ago even, or maybe 25 years ago, this was not possible. These assets were not available for investing. So people couldn't buy these assets for making money. Of course, some of them are very, very well known, but I just want to know maybe those who are maybe a little bit on the lower part of the slides. For example, investing in intellectual properties, in patents, in property rights, etc., is very important now because this is knowledge, this is innovations, etc. Secondly, just for fun, emotional assets. I don't think it's a very important part of the market, but this is, this is very nice to talk about. Emotional assets, I mentioned 3 of them: art, wine, and whiskey. These are really parts of investments, but this is minor part of assets. But people like this because they can talk about it. They go, oh, this is a nice bottle of wine, and this is from this year, etc., etc. And this, either the bottle is sold on the market, or there are indices in the market. So you don't invest in particular bottles, but you invest in index that shows the prices of different sets of bottles. And of course, maybe not driving force, but something that's very important: digital assets. And of course, you know about this because this is the main story in the media, etc. It's a little bit hype, actually, and a little bit of buzzword, but we have to take this into account. So cryptocurrencies, they are mentioned here, including CBDC, which is central bank digital currency. It's coming, definitely. In some countries, of course, it's available, not in the most important countries yet, but this will come to some extent, even by European Central Bank. And finally, different tokens. Tokens are more important than cryptocurrencies, definitely. Cryptocurrencies is something a little bit not so important. Maybe even that you think that Bitcoin is important. Yes, it's important. But the economy develops because people are using tokens, not non-fungible tokens, no, but just tokens which are security tokens or utility tokens. Okay, these are main types of risk. Again, these are traditional types, which is in the maybe top of the slide. But there are the new types, well, not necessarily new, but those who should be taken into account, particularly from my point of view, something that is very, maybe not dangerous, but should be taken into account. Media risk is, before 20 years ago, this was mostly media risk related to traditional media. Now, of course, it's related to social media. Especially, this is huge risk of disinformation. This is a huge wave of disinformation that is being sent to the market by social media. Be aware of this. This is one of the, I think, in the world where they consider which is the most important risk in the world now is no longer climate risk. Climate risk becomes number 2. Number 1 is disinformation, okay? Key drivers now, future. Key drivers in long term, I think that's 4 of them. Especially we should be concerned about demography, not much discussion about this, this migration, but also aging societies. Global shift to Pacific, that's maybe not good news to Europe, but many parts of business and also financial markets, this is Pacific. By Pacific, I understand also New York, which is not Pacific, which is Atlantic, but this is the same area, actually, I say. Okay. And now the last part, artificial intelligence. This is not only future, it's present, I think, but I listed here the main areas where AI, question is what's AI? 99% of people, when they ask what's AI, they would not answer. AI is the replacing cognitive processes that are made with the human brain by the algorithms that were, of course, made by humans. So there's no artificial intelligence. This is still human intelligence, which creates some tools that are very helpful. And I think I mentioned here the most important areas. Some of them are this is already done, but there are some which are more, sophisticated, and especially portfolio management, things that are very much creative and personalized will be replaced by AI very, very late in the future, if any. So remember, something that can be repeated, that's done. For example, financial reporting, accounting, bank clerks. This is all replaced by automates now, but not very much advanced things and very much creative things. Okay, a little bit about machine learning. I'm slowly moving to the end, but machine learning is nothing else than you have data, you have methods, and you have tool. Question is that the tool comes from a creator of AI, goes to the end user of AI, and there is something in between which we call black box, because usually it's not explainable. So end user does not know what is being inside, which might be sometimes dangerous. It's coming on the next slide, but I said that 3 main successes of AI tools, or machine learning tools in this case: data, credibility, okay? Secondly, appropriate methods used. Third, customization. So the system is customized to the need of end user. There is nothing like one size fits all. Don't believe in this. If something is for everything, it's for nothing, right? So you have to have dedicated things which can be very powerful. Unfortunately, they are not scalable and they might be very expensive. That's the main problem, okay? Main threats, and here these are main threats. I call it usually, following Harari, the first one, artificial intelligence and natural stupidity, which means that end user does not understand the tool. That could go to the very bad threat, etc. Secondly, unfortunately, there is also artificial intelligence, artificial stupidity. That creator, I'm not talking of the best systems in the world, you know them, but I'm talking of anything that they say, oh, we have artificial intelligence system. You ask them what they did, creators, they couldn't answer even. So be aware of these things. These are amateurs, these are not professionals. And finally, of course, who is the most dangerous for this one? I think two objects, let's say, or something like this. First of all, these are, okay, I give it in different direction, but harmful influencers. I'm not talking about there are good influencers and they do very good job. I'm talking about harmful influencers who are in some social media, for example. They don't understand they are talking about, but this is not their role. They want to make money on this in the next 2 years, and that's over. This is the end of the life, right? So these are first thing. Secondly, of course, generally social media. So these are the two things which you have to be aware that they might cause the big problems and threat to the users of new technology, etc., etc. And finally, main takeaways. Main takeaways are such. Show will go on, of course, and this will go on even more exciting. But please do remember that financial market is not show business. It's not that media can show business, it's show business. This is very exciting and everybody likes this, showing this, etc. No, financial market is serious stuff because it can support the economy. Secondly, very important is education, of course. That's what you can save, this main weapon. Long-term thinking, also forward-looking and understanding. Understand education. Do not allow to take you over your human intelligence. If your human intelligence will govern AI, this is great. If opposite happens, you are lost, okay? You will be, nobody, because you will be governed by AI. Thank you very much. I think this was a short presentation, but I think this topic could be explored over, 40 hours or something like this, but you will be bored, of course. Thank you very much, and good luck in finance, investment, etc.